So we've now just had the 13th in a row consecutive Bank of England base rate increase. It now stands at 5%, up from the last one of 4.5%, which was announced 6 weeks ago. And this increase of 0.5 percentage points was actually larger than most economists and markets had been expecting. They were most people were thinking up until yesterday, expecting it to be a smaller 0.25 percentage point increase. So it was a much, much bigger jump up than we anticipated. So in this video, I'll quickly take you through what the kind of markets are implying for future interest rate increases, if there were going to be some, what the Bank of England said in their minutes, how they came to that decision. And then let's also talk about what that means for savings and for mortgages right now. So let's talk about that decision, shall we? So some of you might know, if you watch my updates every time there is one of these meetings, there are 9 members of the Bank of England Monetary Policy Committee, and they all have a vote in what they should do. They can vote to increase it, they can vote to keep it the same, they can vote to decrease it. Well, this one, as has been the case for the last few of these meetings, the decision was 7 people in favour of a 0.5 percentage point increase and 2 increase in favour of no increase at all. They didn't want to increase it by a small amount. They didn't want to increase it at all. So why is this? Why are they is there a split here? It's a relatively small split, but why are people sort of deciding on different things? Well, the reason why interest rates are going up is because it's one of the very few, if only, kind of methods that the Bank of England has in terms of controlling inflation. Inflation, as I'm sure you know, this is how much prices are increasing year on year, so how much more expensive things are. And we've had a period of very, very high inflation, around sort of 10, 11% over the winter and early spring, starting to drop down. And we had the most recent figures yesterday, so representing how much things have gone up by over the last year. And it remained level at 8.7%. Now, you might think, well, that's good. It's not going up. But saying the same wasn't good either. It was expected that it would drop down, not significantly below that. 8.4% is what they were thinking, but it didn't go down there. It stayed where it was. And if you go beyond that, inside those inflation figures, you go to something called core inflation, where you strip out the gas prices and the food prices. And we know that energy prices, obviously, they are going to come down. They have started. We know from price cap in July, they're going to come down a fair bit. You know, food prices have been incredibly high. They're still increasing by a large amount, but not as much as they were. But if you strip those out, you've got this thing called core inflation. That actually went up. And it's actually gone up to one of the highest figures in a long, long, long time. And that has kind of probably spooked the Bank of England. Not spooked, encouraged the Bank of England, those 7 people of that 9, to go for this even larger increase than was anticipated, that 0.5 percentage point increase. And the whole point they're doing is, well, why do this? Why would you increase interest rates? Because that's going to put a load of pressure on our spending, particularly if you've got a mortgage. You know, the extra costs that are going to come every single month if you're not locked into a fix right now are going to be really, really, really high. And we'll come back to that in a moment. But that's the whole point behind it. They want us to spend less money, partly because if you've got a mortgage, you have less disposable income. You can't go and spend money on those extra bits and pieces, but also because it will have an impact on savings accounts. And if your savings rates go up, you might be tempted to save money instead of spending it. If, from either of those reasons, you're spending less money, that means the retailers, the manufacturers, whoever it is out there, if they want to still shift their goods or their services, they're going to have to lower their prices. And obviously, if you lower prices, that would effectively come into a lower inflation. Now, doesn't necessarily mean prices will come down. It might just reduce how fast they go up. Because if they were to actually reduce, that would be deflation. And that's very, very unlikely. So these high prices are here to stay. It just might mean that inflation, rather being that 8.7% point where we are right now, it'll get to, this is their long-term goal for the Bank of England, is to get it to 2%. If inflation is at 2%, they feel that's a kind of a fair thing for going along. And when we get to that, then obviously the rates don't need to be as high as they are right now. But that's one part of the thinking, right? That's what those 7 people are thinking. Let's keep increasing because inflation is still too high. We need to bring it down. We need to stop prices increasing as fast as they are. The other 2 people, and other people will share this opinion as well, will say, well, we've already had 12 price hikes. You know, going back to December of 2021, when the rate was 0.1%, the base interest rate, was 0.1%, to where we are before this meeting at 4.5%, where we are now at 5%. That is a lot of increases in 18 months. You know, 13 increases we've had now. And they'll say, well, it's too early to say whether those increases will have an impact. It's not like you do it straight away and things change. They take time. They take years potentially to come about. So those 2 people have been saying for quite a few meetings now. I think it might be different people this time, but they've been saying for a while now that we need to wait and see. We need to hold fire. We don't want to keep increasing it, because if you keep increasing it, you put even more pressure on people, more pressure on the economy, and that potentially could push the UK into a recession and all sorts of things that come with that. So that's where that decision process went from. A lot of them thinking we need to keep going. This is all we can do. And the Chancellor, Jeremy Hunt, he supports that. He says that is the only way and the best way to tackle inflation. And they really want to bring down inflation, the Conservative government, as we all do. But that's one of their kind of big things they've said they want to do. Whereas the other two, well, it's wait and see. So that's where we are on that. So that kind of sounds like, okay, we're at 5% now, but what does that mean for the future? Are we going to stop at 5%? Is this all it's going to be? Because if you go back, just my update 6 weeks ago, the anticipation was that maybe we'd go up to 4.75% and peak there, and then maybe stay there for a while, then start dropping down. Well, we've already gone past that. We're now at 5%. And if you look at what the markets are pricing in, and again, I'm not an expert on these things, but this is basically where they look at where you could look at how people are choosing to invest and how they're going to sort of price things in. It's looking at basically the longer term, where they think the rate is going to go. They're not saying it's sticking at 5%. They're saying it could reach 6%, potentially go up all the way to 6% by early 2024. And in the Bank of England meeting minutes that were released just a while ago after they made the announcement, they are saying they're looking at about a 5.5% average on their rates for the next few years. So that is high, a very, very high rate. Of course, if you watch these updates regularly, you'll know that what I'm telling you, there's never a consistent message. What I say from one video to the next, based on what the markets and based on what the Bank of England have said, doesn't always follow through. So though this is where they're thinking about it right now, and as we get onto savings and mortgages right now, how that is being priced in, it doesn't mean this will happen. All sorts of things could happen. Inflation could suddenly fall a lot faster than expected, in which case, well, they won't increase the rates, or unlikely to then keep increasing rates. If anything, potentially, if it really, really dropped down faster than expected, they might start cutting it earlier than expected. But certainly, all the thinking right now would be suggesting that we will see more increases this year, potentially even early next year. And then when it does start to come down, it's not going to be like this. We're not going to go back to those 0.1% rates, even those 1% rates that we were having over the last sort of decade or so. No, they are going to be potentially, dropping down a little bit from, if it does go to 6, to say to 5.5, then to 4. A new norm for interest rates could well be around that 4-5%. Again, we don't know, but it's worth having that in mind when you're thinking about some of the things you're going to do with those different products out there. So let's start off with savings, because this is an easier one to kind of go through. What does this mean for your savings? Well, it doesn't necessarily mean anything, because although the banks, when they get the interest rate that the Bank of England has given when they have money with the Bank of England, they're now be getting 5%. They don't have to pass it on to us, and many of them don't. And there are still a huge number of accounts out there paying nothing or practically nothing. So if your money is in an account that doesn't earn anything or earns a low rate, you're being fobbed off, because the banks, it's not as simple as this, but the banks ultimately, they're getting their 5% on that money, but they're not giving you the 5% on that. So absolutely, it's a good opportunity for you to kind of just review that, check what you're getting and if there are better rates. But there are a number, so not all of them will do this, but there are a number of providers, and they might be ones you haven't heard of. If you watch my regular saving update videos I do every single month, then some of the names might be familiar, because a lot of these ones are repeat. Often they're at the top of the tables. But a lot of these banks they are offering, and sometimes this is a kind of a competitive thing. They want to get their name out there, so they offer a higher rate of interest. Or sometimes they're smaller ones. They want to quickly build up a borrowing book. They kind of get all this money from you, which they can lend off elsewhere, and they do it quickly at a high rate, and then maybe the rate disappears. But there are a number of these who have been very competitive, and we have seen yet more big increases across the board. Again, I would do at the start of July another video update looking at all the latest ones. But if you want to see what's available right now or any other day, head to my website, becleverwithyourcash.com/savings. That's where you'll see a daily updated best buy tables across all the different ones. But I'll give you, at the time of recording this, and things could well change this afternoon, tomorrow, next week. But where we are right now are some highest rates you would have seen in 15 years, something like that. So you can get 4.15% from Principality Building Society on a limited access account. You can get 4.11% on an easy access account from Oxbury. I wouldn't be surprised if a couple of the names like Tandem and Chip, who have just made some increases, respond to that so they can go back near the top of the tables in the coming days or weeks. Again, might not be straight away, might be in a bit, but they want to be at the top. Then you've got it's been around for a while now, but you can still get 5.12% from the Barclays Blue Reward Saver. You can still get 7% from First Direct's regular saver. They haven't changed those ones, but other changes with the fixes, 5.7% from Ali United via Raisin for a 1-year fix. There was more than 5.6%, in fact, on all those different sort of terms. Some really, really big rates. Now, a lot of them, these fixed movements we've seen recently, again, some big increases since our 6 weeks ago. They would already have priced in a hike happening now. They may already have priced in potential hikes happening in future meetings. So it doesn't mean that just because we've had a 0.5 percentage point increase today, that we're going to see that happen to any of the accounts I've just mentioned. It may well be they've gone up. We were anticipating an increase. We've already factored it in. The fact that most people were saying until yesterday or today that it was going to be a 0.25 percentage point increase to the base rate could suggest that there's room there for them to do a little bit more on top of that. So maybe we'll see a flurry of increases on top. Still below that 5% rate, obviously, on easy access, but above that on the fixes. We may well see some of them doing that. And again, going back to what I said a moment ago, that competitive edge as well, with some people wanting to be at the top, they might then jump above that. So interested to see what happens. But just to restate what I said, just because we have seen a 0.5 percentage point increase doesn't mean your bank will increase your savings rate by that amount. Also doesn't mean that if they do increase them, they'll increase it by the full amount. They might only increase it by parts of that. So I just repeat again, I keep saying repeat myself here, but it's really important points I'm trying to say. Check what you're getting, check what you can get elsewhere. And if I would say now, you want to be getting at least 3.9% on easy access, at least 5.5% on a 1-year fix. Just bear in mind with those fixes, of course, if we do see more increases, those rates could go up even more. And if you're locked in, then you won't be able to get out of those fixes. But you could potentially balance things out a little bit and maybe have some in a 6 month, some in a 9 month, some in a 12 month, some in an 18, some in a 24 month, just so you've got that potential that if things are in the same position in 6 months and a year, then you're able to kind of get those sort of slightly lower, higher rates, or keep some of it easy, fix some of it now, some of it in easy access, and then see what happens to put more into a fix next month, more in the month after if rates are going up and down. So one last thing to say on savings before we get onto mortgages. There has been a lot of pressure. You might have seen it in the press or on social media over the recent weeks. People saying, look, it's not fair that the banks are not passing on these increases in full to customers. If that does get more traction, if more people are kind of getting behind that and they get the government to maybe make some changes to kind of force that or heavily sort of suggest they should be doing that, then I don't think we'd see suddenly all of them adding more on. I think what you see is maybe the ones at the bottom are leveling up slightly. So we'd see more around that kind of same margin at the top rather than have such a big gap that we do get. And that's no bad thing for people who don't take any action. So at least if you do nothing, you'll get better than you are. But I think there'll still be room at the top for people who are looking around and willing to move their money to get higher rates. But I don't think those higher rates will necessarily move as a result of something. If it happens, it may not happen. Right, let's talk about mortgages now, because this is the key area of borrowing which is impacted by the increase in rates. Yes, credit cards and loans could have some impact, particularly new loans, but generally they're fixed. So if you've got one, that's not going to impact you. It's just if you want a new one, it could. But let's talk about mortgages, because this is obviously what's been hitting the headlines so much recently, and understandably so. And the term a lot of people are using is a mortgage time bomb. Because although right now this increase will have an impact on a decent number of people with mortgages, there are far, far, far fewer people who have variable rate mortgages now, where the rate could change straight away and they can change it by however much they want. They're going to be paying a lot more straight away. Similarly, tracker mortgages, they're going to be paying a lot more straight away. The vast majority of people are actually in fixed deals. And the vast majority of people in fixed deals, they've got fixes that aren't finishing now. So at the moment, the people who are going to be really impacted are the ones on variable deals or the people who are looking to their fixes finishing in the short term. There's going to be a massive, massive, massive jump from the people currently on fixes that end to get a new fix from maybe like below 2%, where they might have got if they fixed a couple of years ago, to now where a 2-year fix on average is over 6%. Again, they might be able to get better deals, but the average one, that is a big, big jump. And a huge number of people could be, so a small number of people right now, a significant but small number of people could be impacted by that. You know, an extra £300 every single month potentially is a report from Institute of Fiscal Studies was saying for those. About 1.4 million people will find their disposable income drops by 20% as a result of this. You know, that is a lot, but it could get bigger. That's why I talk about this term of a mortgage time bomb, because every time these fixed deals in tranches come to an end, more and more people will be coming out of this environment of a low interest rate from their fixed to a high one, potentially could get higher. So it's very, very scary. There's obviously a lot of talk right now. We may well see some stuff coming from the government in terms of support, but you've got to remember the whole point of these interest rate rises is to make it harder for people to spend money, and for people who have mortgages to have them less disposable income to go out and spend cash elsewhere. So anything that might come along, it may not be anything financial or to stop this happening. It might just be more in terms of support. Again, if there is anything, I'll obviously let you know on the channel. But it's important to know this is happening. So what can you do about this? Well, if you are someone on a variable rate mortgage or a tracker mortgage or a fix that's coming to an end, I really think the best thing you can be doing is talking to a mortgage broker, a mortgage advisor, to get their sense. They understand the full market. They know the different options out there. There may well be, and these do exist, but not all of them are like this, some fixes that you could look at where you can secure a rate, but you don't necessarily have to take it later on in case rates have dropped elsewhere. But you can do that without any charges or any fees. You don't want to obviously pay some money and then if you want to exit it, lose that money. So again, the brokers will know about this. They might also be able to suggest different things you can do. Maybe they might suggest sticking on a tracker mortgage for the moment, which again could be more expensive, but it has that flexibility for you to get out of it if deals come down. And although they say these deals are very, very high right now, the mortgage rates are very, very high, they are pricing in the expectation of where we will go. So it could well be that they can't get any higher. Again, you need to talk to some advisors, but even then, these mortgage brokers, they won't know for certain because we're saying very different things today as a result of this announcement than we would have done 6 weeks ago, 12 weeks ago, or the previous ones. It's a really movable feast, which I know isn't any comfort to you if this is a situation you're in and you're worried about how you're going to afford your mortgage repayments. But again, it's something not to sort of just stick your head in the sand. It's something to take action on and see what you can do. And as a final point here, just as a reminder that if you are really struggling with your mortgage, if you're not sure how you can make those repayments, or it's having an impact on other spending you've got, you know, it's not just your disposable income it's dropped away and disappeared. It's your actual ability to afford your essentials. It's about talking to those different people that you potentially are going to be or are already in debt with. So your mortgage lender, talk to them, see what they can do, see what you can have in order to kind of help you get through this period before hopefully things get better. If you have other debts, it may well be that some of them, if they're building up, some of them are priority, some of them aren't. Talk to someone like Step Change or National Debt Line. These are debt charities. They will not charge you for the advice, and they'll help you work through the next steps and find the best ways to process this before things get really, really, really bad. And hopefully you can avoid, moving it into something like problem debt. That's it for this update. Remember, becleverwithyourcash.com/savings is where daily updates of the best savings rates are. So you'll be able to find out any movements if they come along up across the board there. My name is Andy Webb. Thank you so much for watching. Check out these videos right here for more ways to boost your savings.